Well, welcome everybody. This is Hungry for Moat with Avinash and Prabhat. We are going through the letters of Berkshire, not Berkshire Hathaway. Okay, this is Buffett Partnerships, and we are on the year 1961, the latter half of 1961. Now he has recently decided he's going to do letters every 6 months because he's a rock star and his fans want more communication. You
Yep,
know.
that's right. So twice a
Uh,
year.
Twice a year. So last year was kind of summer of 1961, and he covered the first half, and now we're going to talk about the second half.
Hmm.
And previously, just kind of discussed mostly his kind of structure. He's trying to restructure and have things consolidated.
Yeah,
He didn't talk too much about details of his investments. Maybe he will do now.
yeah.
Okay.
And this is him at age 31.
All right. All
Yeah,
right.
still.
Pretty young. 60 years later, he's like what, 92 now, 91 now? The dude is like, hope he never dies.
Yeah, yeah.
Can you imagine how much money he'll have?
Oh, I can't wait to read into this. It's going to be fun.
All
It's the
right.
start of his money journey.
Our performance in 1961. He doesn't even bother with the stock market now. He's like, our performance. I have consistently told partners that it is my expectation and hope, it's always hard to tell which is which, that we will do relatively well compared to the general stock market in down or static markets, but we may not look so good in advancing markets. In strongly advancing markets, I expect to have real difficulty keeping up with the general market. Although 1961 was certainly a good year for the general market, and in addition, a very good year for us on both an absolute and relative basis, the expectation in the previous paragraph remained unchanged. During 1961, the general market, as measured by the Dow Jones Industrial Average, hereinafter called the Dow, showed an overall gain of 22%, including dividends received through the ownership of the Dow. The gain for all partnerships operating throughout the entire year, after all expenses of operation, but before payments to limited partners or accrual to the general partner, average
Wow.
45.9%. Golly. The
Incredible.
details of this gain by partnership are shown in the appendix, along with results for the partnerships started during the year. What the heck?
Okay, let's take a quick break and really find out what's going on here because he's advising his stockholders to not expect this in the future. And because it's a bullish market, you should not be. We should not be outperforming the general stock market, but yet he is. So my question to you is, why? Why is he outperforming the market? But now, if you owned Berkshire Hathaway when the lockdown happened, isn't it? Wouldn't it? Now we wouldn't get the same gains as if we put it in just the S&P 500. Is that correct?
Yeah, I mean, either he's finding these securities that are so underpriced, and he's able to unlock value uh, while benefiting, while maybe bringing him to the light that other people are, you know, also getting in the stock as he's getting out.
Mm-hmm.
So he's taking unpopular stocks and getting in and then popularizing them. That's one strategy could be doing.
Mm-hmm.
Or he is buying things that, well, he's not going to be buying things that are overvalued. One thing would be he buys
Yep.
things that are average value and then they become super bloated.
Yeah.
But that's not his style.
Right.
Or maybe he's just finding such big discounts that he's search looking for this 50%.
Yeah.
I mean, one thing you'll notice his performance is consistently around, like I think his goal is 50% annual
Yeah.
rate of return.
Mm-hmm.
That's his personal goal. He doesn't care what the market is doing,
Mm.
even though he tells you he tries to do the average of the market.
Mm-hmm.
And I think he's finding situations where he can get in and be an activist investor and unlock 50% of profits.
Okay, but the question still stands: is this a better investment philosophy than what he has now? So
Absolutely, 100%.
his investment philosophy now is find the cigarette butts, find out if they're undervalued, just to sell them when they're overpriced. Why shouldn't someone starting off do that instead of hold for the long run?
So Buffett tells you should do this if you're working with small amount of capital. If you're working with small amount of capital, you should be looking at small businesses, small companies that the big players don't have access to or don't are not interested. But as you
Interesting.
get bigger, I mean, then you don't wanna you're not agile. You just want to pick a good businesses and just leave everything else.
Yeah, makes sense. So when you're small and you have a small amount of capital that you can double very easily, then you should do the cigarette butt type of model, if that's the case.
Correct. I believe so. I think that is what
Wow.
he's saying.
Okay.
I'm gonna adjust my camera just a little bit. There we go.
Interesting.
Okay. Um, we have now completed 5 full years of partnership operation, and the results of these 5 years are shown below on a year-by-year basis, and also on a cumulative or compounded basis. These results are stated on the basis described in the preceding paragraph after expenses, but before division of gains among partners or payments to partners. Okay, look at this table. So it talks about 5 years,
Yep.
and 1957 to 61. The year 61 has concluded now, and yeah, he shows you growth in his number of partnerships up to seven now. Grew pretty quickly, and gain of partnership. These are annualized, I believe, 10, 40, 25, 22, and then 45.
Yeah.
While Dow Jones is all over the place. The -8, then 38, then 20, then -6, then 22. This is doing pretty good, man. If you're
Yeah.
indexing, that's still not a bad index performance during those years.
Yeah. Even I mean, 22%, 38%, 20%. I mean, the average, historical average is what, 7, 8%? Right?
Yeah, and look at
So,
the next section here, including dividends. I mean, these are including dividends, sure,
yeah.
received through the ownership. And now look at the compounded chart.
On a compounded basis, the cumulative results
Yeah, and he
have been.
clarifies, like if you go from 1957 to just that year, it was 10. If you held for two years, it was 55 to 95. So in those 5 years, the partnership had 2.5x,
Yeah.
250%
Yeah.
performance, while Dow Jones had 74. I mean, you almost doubled your money.
Yeah.
So and that's almost going at like 10 to 15% of just the Dow the index giving you good performance. I mean, it's no Buffett, but I mean, it's not terrible at all.
Yeah, no, I totally agree. But it's still pretty good for someone who says, "Hey, we should actually be underperforming during bullish times," because he's still killing it. Like if you look at the 20 or 30%, 26.7, 26.9%, he's killing it, 55.6. You look at 52%, he's doubling it almost, 95.9%. 42%, 140%. Yeah, I don't know. I feel like even if this is calculated on a compounded basis, even then he's clearly outperforming the market in both the downturns and the upturns.
I agree.
Again, okay, so sorry to kind of belabor the point because I'm still trying to understand why this would not be the best case. Let's say that you find super undervalued stocks. Does that mean that it's immune to shifts in the market below? I mean, if it's a bullish or a bearish market, it doesn't really matter unless you find stocks which are undervalued by the market for whatever reason.
Your question is, well, what's your question though?
So the question is the purchase of an undervalued cigarette butt like stock immune to whether the market is bearish or bullish?
No,
No.
I mean, market is about sentiment, And a bad sentiment, bearish market will drag everything down that trades on the stock market.
But that's not true here, because you.
What he's doing, he's not just buying cigarette butts. He's buying things that don't really trade on the stock market. I mean, that's what he's really doing. He's buying companies that are so small that to buy stocks, you have to figure out who's selling the stock and talk to them directly and and buy stocks from them.
Okay.
Right? He found
Right.
the family who's trying to sell the majority position. He's like, okay, I'll buy it from them. He's not really going through the stock market
Yeah. Okay, got it. So no hedge fund at that time would actually be looking at this at all.
because it's too small, and I mean
Yeah.
it's just too obscure. I think.
Yeah. Okay. Gotcha. Interesting.
The results do not measure the gain to the limited partner, which of course is the figure in which you are most interested. Because of the varying partnership arrangements that have existed in the past, I have used the overall net gain based on market values at the beginning and end of year to the partnership as being the fairest measure of overall performance. Excuse me. Oh God.
Bless you.
Thank you. Thank you. On a pro forma basis, adjusted to the division of gains entailed in our President Buffett Partnership Limited agreement, the results would have been following. So now he's telling you how the partners actually did after Buffett took his commission.
Oh, I see. Okay, so that's what pro forma means?
I don't know. I don't know what pro forma means, but that's what he's trying to do.
Okay.
Okay, so Dow Jones doesn't change. The first step was annualized, and second is compounded. And I mean, clearly, he's compared to the index, he's doing just fine. I mean, they have done better than the index
Yeah.
every except for 58.
Yeah.
But I mean, look at when every other. I mean, he's like 10, 20, 30 points above index in some of these years.
Yeah. Yep. Yeah. Clearly killing it. Yep.
Beautiful. And the keep compounded. I mean, that's like double.
Yeah.
Right by the 5 years, you double the money with Buffett compared to the index.
Yeah.
More than double.
Yeah. Incredible.
That's why he the boss. A word about par. The outstanding item of importance um, in my selection of partners, as well as in my subsequent relations with them, has been a determination that we use the same yardstick. If my performance is poor, I expect partners to withdraw, and indeed, I should look for a new source of investment for my own funds. If performance is good, I am assured of doing splendidly, a state of affairs to which I am sure I can adjust. Uh, the rub then is in being sure that we all have the same idea of what is good and what is poor. I believe in establishing yardsticks prior to the act. Retrospectively, almost anything can be made to look good in relation to something or other. I have continuously used the Dow Industrial Average as an our measure of par. It is my feeling that 3 years is very minimal test of performance, and the best test consists of a period at least that long where the terminal level of Dow is reasonably close to the initial level. While
Okay.
the Dow is not perfect, nor is anything else as a measure of performance, it is the advantage of being widely known as a long period of continuity and reflects with a reasonable accuracy the experience of investors generally with the market. I have no objection to any other method of measurement of general market performance being used, such as the other stock market averages, leading diversified mutual stock funds, bank common trusts, etc. Should we stop here and Summarize.
Well, I think the main thing is he wants to make sure whatever we are considering as successful as his partners are the same as what he's measuring as success as partners. So
Correct.
with anything that's measurable, it's always relative. And so we have to have the same thing that we're comparing against. And so here he's suggesting let's all agree to compare against the Dow and check our performance compared to the Dow.
Yeah, and he's saying, I mean, he's open to other things, but Dow is.
Yeah.
I mean, he's not comparing it to the bond. Like he's still comparing to the a very major index.
Yeah.
So yes, you may feel I have established an unduly short yardstick in that it perhaps appears quite simple to do better than an unmanaged index of 30 leading common stocks. Actually, this index has generally proven to be a reasonable tough competitor. Arthur Weisenberger's classic book and investment companies lists performance for the 15 years 1946 to 60 for all leading mutual funds. This is presently over $20 billion invested in mutual funds. So the experience of these funds represents collectively the experience of many million investors. My own belief, though the figures are not obtainable, is that portfolios of most leading investment council organizations and bank trust departments have achieved results similar to these mutual funds. Weisenberger lists 70 funds in this chart and statistics, which continues records since 1946. I've excluded 32 of these funds for various reasons, since they were balanced funds, therefore not participating fully in the general market rise, specialized industry funds, etc. Of the 32 excluded because I felt a comparison would not be fair, 31 did poorer than the Dow, so they were certainly not excluded to stand the conclusions below. Of the remaining 38 mutual funds whose methods of operation I felt was such as to make a comparison with the Dow reasonable, 32 did poorer than the Dow and 6 did better. The 6 doing better at the end of 1960 when 1960 had assets of about $1 billion and 32 doing poor had assets of about $6.5 billion. Um, None of these six that were superior beat the Dow by more than a few percent points a year. Below, I present the year by year results of our period of operation, excluding 1961, for which I don't have exact data, although rough figures indicate no variance from 1957 to 60 figures. For the last largest common stock open end investment companies and the two largest close end investment companies.
Wow. Okay.
Okay, so he expands on the idea of what our yardstick is, which is the Dow and why, and kind of goes into the spiel of, well, yeah, anybody can beat the Dow. It's an unmanaged fund that is just the 30 biggest companies.
yeah.
I'm like, yeah, you would think that, but guess what? Index funds are really difficult to beat.
And I didn't know Dow was only composed of 30 stocks. Did you? I did. I mean, is that
Yeah, Dow is the industrial. It's not S&P 500. I mean, they pick which company. It's not just the 30 biggest company. They
okay?
pick certain companies. I don't know
Oh,
how they decide this.
interesting. Okay, even to this day.
It may have grown to 30, but it's definitely not 500.
Okay, okay, interesting. And
But it's
yeah,
usually old type companies. They don't really have new companies. But I think Salesforce is part of the Dow.
okay, interesting. But also another yardstick that he's proposing here, correct me if I'm wrong, is that he's comparing against other hedge funds or other partnerships, right? So you have Tricount, Lehman, Mass Inv Trust. I don't know about these guys, but it seems like he's comparing himself against others.
Exactly, exactly. And to kind of tell you what's in the Dow today,
Uh huh.
is United Health Group, which is the insurance company, Goldman Sachs, Home Depot, Microsoft, Salesforce, McDonald's, Honeywell, Visa, Amgen, Boeing. And these are the top 10 holdings
Okay,
in terms
so
of weightage.
okay, gotcha. And how much is the like? How much does that cover in terms of weight? Is that 80% of the portfolio?
That covers about more than 50% easily.
Okay, okay, interesting. Okay, so I have a little bit of a beef here if I was a shareholder of Berkshire because or Buffett Partnerships Limited, I should say. The reason is
Uh-huh.
because you I mean, he probably didn't outperform all of the hedge funds out there or the investment firms because we know that some will get, it's the hot hand fallacy kind of thing where some people are just hot for a few years. So I guess, you could probably find investment management firms which probably outperformed him for these 5 years. That's my only little beef.
But he tells you like how many did better than the Dow. He tells you that six did better, and none of the six were better by ridiculous amount. So he's gonna tell you. I mean, he's not comparing himself to those. I think the six that did
Right.
the best. I think he's comparing himself to the largest ones.
Okay, but that's almost like comparing against the Dow. I mean, he could
Well,
showcase
his
another
point is
chart here.
his point is not to compare himself to these. His point is to compare Dow to these.
Okay, okay.
So he's saying this is about why Dow is a good yardstick for
Yeah,
us.
yeah. Okay, that does make sense. Yeah.
And
Um,
clearly Dow beats all of. I mean, I think Dow beats all of them.
no, not
So
in '58.
cumulative.
Yeah,
Well, let's look at down.
cumulatively.
Let's look at the second table.
Oh yeah,
It's pretty. I mean,
yeah. It's
two
up
do
there.
better, two do worse.
Yep, yep.
Unlimited partners is like on another level.
Yeah. Okay. All right. The compounded table is probably getting me excited then. Yeah. Okay, makes sense. All right, Buffett's still the man. I take it all back.
um, the Massachusetts Investors Trust has net assets of about $1.8 billion. Investor Stock Fund about $1 billion. The Tricono Corporation about $0.5 billion, and Lehman Corporation $350 million. A total of about $3.5 billion. I do not present the above tabulations and information with the idea of indicting investment companies. My own record of investing such huge sums of money with restrictions on the degree of activity I might take in companies where we had investments would be no better if as good, which is a lie, clearly.
Yeah, clearly.
I present this data to indicate the Dow as an investment competitor is no pushover, and the great bulk of investment funds in the country are going to have difficulty in bettering or perhaps even matching its performance. Our portfolio is very different from that of the Dow. Our method of operation is substantially different from that of mutual funds. However, most partners, as all alternative to their investment in the partnerships would probably have their funds invested in a media producing results comparable to the Dow. Therefore, I feel it is a fair test of performance.
Yeah. Let's stop there for a second. Are you convinced that the Dow's a pretty good yardstick or comparison
I
against?
think so. I don't know if they had S&P 500 back then, but I mean,
Yeah.
we don't. Most people don't use Dow anymore. They use S&P 500. I think Dow somebody decides which are the blue chips, and S&P 500 just market weightage whatever the top companies are get to be in the like. There's that's S&P 500 is more mechanical. There's no argument. Where Dow I think invites companies in, and it's like a big thing. It's like, oh, they're now in the Dow.
Yeah. I'm kind of convinced that something like that also is probably a good yardstick. I mean, I think he goes above and beyond to really convince us, but I'm already convinced
I mean, I would
it's
think S&P 500 is a better yardstick if it existed. Like I
right.
would, but it must not.
Yeah.
Our method of operation. Our avenues of investment break down in three categories. These categories have different behavior characteristics and the way our money is divided among them will have an important effect on our results relative to the Dow in any given year. The actual percentage division among categories is to some degree planned, but to a great extent accidental, based upon availability factors. The first section consists of generally undervalued securities, herein called generals, where we have nothing to say about corporate policies and no timetable as to when the undervaluation may correct itself. Over the years, this has been our largest category investment, and more money has been made here than in either other categories. We usually have fairly large positions, 5 to 10% of our total assets in each of five or six generals, with smaller positions in under 10 or 15. Incredible. Wow. Okay.
So let me try and see if I understand. So he's saying, look, our operations are going to be broken up into three different sections now. The first section is going to be undervalued securities. So these are going to be like, would this be analogous to maybe high risk, high reward type of thing?
Well, there right now he's just saying three categories. He hasn't talked about his second two. He's just talking about his
Yeah.
first category. But yes, I think his ice the fact that few make the bulk and others are smaller. I think so. I think those are probably riskier where they may have bigger gains.
Okay. Yeah, and he'll also own more of the companies in these kind of generally undervalued securities.
Correct, but here he's not talking about having any say in the corporate policies. He's not talking about being an activist investor in these kind of companies, which is very interesting. I just find it fascinating how big of positions he's taking there.
Like
I
the
mean,
5
like
and the
that's
10%.
yeah, most people don't do that. I mean, yeah. What do you have to say about that?
Well, I don't know if I mean definitely he's taking huge bets on these, but um, actually I don't know if that's that much. I thought maybe 10% of his total assets is going towards stuff that he finds undervalued. Isn't that kind of low?
We're talking about 5 to 10% per stock.
Oh, in each of the 5 to 6 generals. Okay.
Correct. Correct.
Okay, of the company. So that's like saying I own 5% of a company, I own 10% of a
Yeah.
company.
So he probably picks five or six of the companies,
Yep.
and then he's putting 5 to 10% in each of like yeah. So I mean, if he has five companies at 5% each, that's 25% right there, and then maybe as high as 50%. But each company, I mean, these are not weak bets. They're like
Yeah.
if he believes in them, then he'll go up to 10%.
Yeah.
Most people don't do that. I mean, that's the other than these super concentrated value investors, most people don't have this high convictions. Would you agree?
Yeah, I totally agree. Yeah.
Okay. Sometimes these work out very fast. Many times they take years. It is difficult at the time of purchase to know any specific reasons why they should appreciate at price. However, because of this lack of glamour or anything pending which might create immediate favorable market action, they are available at very cheap prices. A lot of value can be obtained for the price paid. This substantial access of value creates a comfortable margin of safety in each transaction. The individual margin of safety, coupled with diversity of commitments, creates a most attractive package of safety and appreciation potential. Over the years, our timing of purchases has been considerably better than our timing of sales. We do not go into these generals with the idea of getting the last nickel, but are usually quite content selling out at some intermediate level between our purchase price and what we regard as fair value to a private owner. Wow. Okay. What do you have to say about that?
Okay, so he's clearly saying we're not going to hold these forever. This is only for a short while until we make up our gains, and he clearly says that we have had a better track record of purchasing them than of selling them. So he says himself that he didn't time the market well enough in that the selling, if he held on a little bit longer, he might have gotten a better, rate of return. But I think this kind of shows his mentality at this stage of his life where he's saying, even though I can't give you a particular date on when they'll appreciate, I believe that they're going to appreciate. And I feel like they're really cheap prices. And in fact, our record has shown that I'm able to buy these stocks at a very cheap rate. And I've been able to sell them at a profit, but probably my timing has not been amazing. If I held on a little bit longer, it might have gone up. But yeah, generally speaking, I feel that, we're not looking to kind of get the last little nickel out of these companies, but we're okay with selling them at kind of an intermediary higher level. Did you kind of get the same thing?
Yeah, and I think him selling a little bit prematurely is by design.
Yeah.
I don't think he's like freaking out and selling. I think he's only selling because he's finding something else that's even more attractive.
Really, I feel like maybe it's a little bit of the thing of like, man, it's really freaking expensive right now. I think I should sell. I don't know if like I think in
No,
his
he's
internal
no,
radar.
he,
Yeah.
he's selling before fair value. He still thinks it's undervalued when he sells. It's not like he's selling at overprice, overvalued price. He's just selling at still below uh, fair value, but he bought it at a huge discount, so he's just selling at a little discount.
Yeah, maybe. Okay, let's think about that a little bit. So maybe it's because for the market to realize the real value of a company, maybe that takes longer than if you were to say, okay, the market realized that it's not completely fair value, but it's undervalued, and then it rewards you right away, quicker at least, compared to if you were to hold on to a company for a little bit longer and wait for it to get to fair value. So this is like maybe a derivative of when to sell a undervalued stock. But what I'm saying is the rate of rise of the stock is probably higher when you're at the early stage where it hasn't reached its value yet, or its intrinsic value
Perhaps,
yet.
perhaps we were saying, as it gets closer to the
Yeah, it
fair value, the
asymptotes.
price movement
Yep.
kind of slows down.
Right.
Maybe that's what he's thinking, but also he doesn't know. He's saying he doesn't know when it's gonna get to fair value or when the price gonna move. Just because you got in at a lower price doesn't mean the price is gonna move. Stock doesn't know that you own it. You have to go tell people that you own it. I think that's what he does sometimes, and maybe he doesn't. But a lot of people do that on Twitter and online, where they buy into a stock and they tell all the world why this is a great stock and why everybody else should get in after them,
Right,
so they can
right,
sell out.
right. Yeah, the pump and dump type of scheme. Yeah, good point. Yep.
But yeah, I think it's good too that most of his money is made from just buying undervalued stocks that he doesn't really know when they're gonna be valued correctly, and it still works out.
Yeah, and another thing that I gotta give props for Buffett is he doesn't feel too bad about selling them. Like I've had those issues where I'm like, I sell the stock and then I'm like, man, and it went up. What the heck? Why? Why didn't I just hold on to it for longer? He doesn't have
Yeah,
that problem. He's just like, hey,
I don't think
man,
it does.
I'm fine. I'll get my money somehow else quicker. He's confident in himself. That's great.
Yeah. And the generals tend to behave market-wise very much in sympathy with the Dow. Just because something is cheap does not mean is not going to go down. During abrupt downward movement in the market, this segment may very well go down percent-wise just as much as the Dow. Over the period of years, I believe the generals will outperform the Dow. And during sharply advancing years like 1961, this is the section of our portfolio that turns in the best results. Is, of course, also the most vulnerable in the declining market. Okay, what do you understand there?
Okay, so my understanding is that you can't rely on stocks. They're not immune to the market. So even if there's like a market downturn, you will still probably be hit. So just because they're tiny and they're these undervalued stocks, it doesn't mean it's not going to go down. It'll go down. It might even go down the same percentage as the Dow. But he's saying over the long run, the generals or this first section of his portfolio, he's saying will outperform the Dow. So yeah, so that's kind of what I got out of that.
Yeah, and they're big stocks, right? I mean, they're moving with the market. They're not the small illiquid stocks that don't move with the market.
Yep.
And yeah, and I think they're too big for him to do anything in a corporate point. And
Yep.
they're presumably good businesses, and that's the reason they would do better than the Dow in a strong market.
Yeah. Yep.
Okay, our second category consists of
Workouts.
workouts. These are securities whose financial results depend on corporate action rather than supply and demand factors created by buyers and sellers of securities. In other words, they are securities with a timetable where we can predict within reasonable error limits when we will get how much and what might upset the apple cart. Corporate events such as mergers, liquidations, reorganizations, spin-offs, etc. lead to workouts. An important source in recent years has been sellouts by oil producers to major integrated oil companies. Hello, Standard Oil.
Hello. Yes, this makes so much sense. Wait a second. So this is very similar to his like what is that spawner type of or what are they called
Spin-offs?
spin-offs? Yeah,
Yeah.
where they're just going to be they're it kind of doesn't make sense to have it in the larger company. They're going to be into going to larger ones. So he has a portfolio of these companies too, where he's like, this used to belong to someone else, but now they're wanting to become bigger. So that's he's finding opportunity there as well.
Yeah, and they are more predictable. He knows where how he can lose money. There's more certainty in these things. At least that's what he sees.
Yeah.
And yeah, he knows when the event should take place and how much the stock should move. So you can have all these numbers, and it's not just him. A lot of people have made so much money in the workouts category. I mean,
Mm-hmm.
there's a huge following, and the Greenblatt, he loves the stuff.
Hmm.
Ed Munger told Pabrai that one of the three things to look at is spin-offs.
Mm-hmm.
So this cannot be ignored and should not
Yep.
be ignored.
Yep.
This category will produce reasonably stable earnings from year to year to a large extent, irrespective of the course of the Dow. Obviously, if you operate throughout a year with the large portion of our portfolio in workouts, we will look extremely good if it turns out to be a declining year for the Dow, or quite bad if it's a strongly advancing year. Over the years, workouts have provided our second largest category. At any given time, we may be in 10 to 15 of these, some just beginning and others in the late stage of their development. I believe in using borrowed money to offset a portion of our workout portfolio since there's high degree of safety in this category in terms of both eventual results and intermediate market behavior. Results excluding the benefits derived from the use of borrowed money usually fall in the 10 to 20% range. My self imposed limit regarding borrowing is 25% of partnership net worth. Oftentimes we owe no money, and when we do borrow, it is only as an offset against workouts.
Interesting. Man, okay, okay. So this kind of goes against kind of I mean my kind of idiot philosophy of like don't invest with borrowed money. So what's going on here?
So he thinks spin-offs are pretty much guaranteed.
Mm-hmm.
And he's thinking when you're doing right, you're going to get 10 to 20% return in a year.
Hmm.
And the Dow might do more than that. and you're gonna feel pain. Then Dow might go down negative, and you're still gonna get 10 to 20%. So this is more like a high saving yield bank account to him. And if he
Wow.
can borrow at 6% and get 10 to 20% returns, he will do it because he's
Okay.
pretty sure of the returns.
Wow. Okay, but this isn't a blanket statement on all spin-offs, right?
I think it's a category thing where he thinks, I mean, he's doing what, multiple, what, 15, 10 to 15 spin-offs at a time? What do you think?
I don't know. I find it hard to say it's a blanket statement, though. You can't just be like, hey, man, everything that comes out of a company, go and invest and I'll give you 10 to 20% in return. I don't know, man. Like, a good example might be um, what's a bad spin-off? I don't know, Skype, I guess, with Microsoft or whatever. They bought it for so much more um, than what it ended up being worth. So, is it really that great? I don't know. You could say it both ways. I'm just not convinced that it's a blanket statement.
What do you mean by blanket statement?
Like as in it's like an overarching rule that says, hey, if you invest in spin-off companies, you're pretty much guaranteed 10 to 20%.
Oh no, I don't think like every spin-off is a good investment, but he's saying it's easy to find which ones are good ones.
I mean, for Buffett, maybe I don't know. How do you find
I
out
mean,
if
he
they're
feels enough. I mean, he feels like he can borrow up to 25% of the
the whole?
funds, not even Buffett, but the funds
Yeah,
money to do spin-offs, and he feels like that's justified. And this is the guy who doesn't want to borrow ever.
yeah. Okay, so pretty high conviction about the 10
Yeah.
to 20%, but he doesn't really go into how he finds these, I guess. But he just believes in himself that he is able to find these.
He's able to find and they're predictable and the data
Yeah.
is there and you can if you put a little bit of brain then you can figure out which ones are good.
You know that this might be kind of a good lesson just for the average investor, right? Because then this is what it's saying really here is that like you have more data that you can make better judgments off of if it's belonging if there's a spinoff. For example, when Alibaba was pretty much managed by Yahoo, you probably could make like a good bet on Alibaba because you had a lot of data that you could have or analyze before the spinoff. So maybe that's where he finds his blanket of safety.
Yeah. Yeah.
Yeah.
The final category is control situations where we either control the company or take a very large position and attempt to influence policies of the company. Such operations should definitely be measured on the basis of several years. In a given year, they may produce nothing as it is usually to our advantage to have the stocks be stagnant market wise for a long period of time while we are acquiring it. These situations too have relatively little in common with the behavior of the Dow. Sometimes, of course, we buy into a general with the thought in mind that it may develop into a control situation. If the price remains low enough for a period of long time, this might very well happen. If it moves up before we have a substantial percentage of the company's stock, we sell at a higher levels and complete a successful general operation. We are presently acquiring stock in what may turn out to be a control situation several years hence.
Ooh, okay.
Okay,
So
tell me what you think.
okay. This is kind of his long term view of like, hey, I know how to run businesses. Let me be an active investor here. I'm dedicating this third category called control, where I take control, like be an active board member, kind of like what he did with that Maps company. And he's saying, and then, the market's not going to realize that because change of a company is gonna take time, and no one besides the people on the board or maybe the people in control of the company can really change the direction of the company. So that's where I kind of got out of it. Yeah. And also, what's interesting here is okay. I mean, I don't want to put words into Buffett's mouth here, but is he thinking of it in terms of high risk, high reward? is the first category. The second one is pretty much guaranteed. The third one is like long term, far off bets. Is that fair to say?
I don't know if I would put a time thing. I mean, definitely spin-offs. He knows the time. They're not long-term situations.
Yeah.
The generals are so generals and control are kind of maybe two sides of the same coin. He hopes the general stocks to get cheaper or stay cheap so he can buy. I mean, he's buying a general because he knows what he's doing. The company's good, and he wants to build a big stake.
Mm-hmm.
But if he's not able to, then it's a general. He just sells it when it goes up in price. But if it
Mm-hmm.
stays low and he believes in the company, he will buy enough that he can control how and make decisions for the company that will maximize the share value.
Yeah. Okay.
And again, control is kind of mix of generals and the spin-off because he's in there
Yeah.
doing messing around and underneath the hood.
But spin-offs would be like if you separate it from the parent company. Here, I
Yeah,
think
but
it's more like,
he can take a general, pick a lot of stock, become a
yep,
control, and then do a
yep,
spin-off.
yep. That could absolutely happen. Yeah, yeah, yeah. But interesting how when he's 31, I believe, he's pretty active, right? Like a section of his whole holdings is like, I'm going to come in there and I'm going to tell these guys what they need to do for their business, you know?
Yeah, because he owns the most stocks, and he's
Yeah,
not an idiot. He knows what he's doing.
yeah.
Uh, but this is a long letter. Okay, you want to read the next up? Next.
Yeah. So let me try. So Dempster Mill Manufacturing Company. Okay, we are presently involved in the control of Dempster Mill Manufacturing Company of Beatrice, Nebraska. Our first stock was purchased as a generally undervalued security 5 years ago. A block later became available, and I went on the board about 4 years ago. In August 1961, we obtained majority control, which is indicative of the fact that many of our operations are not exactly of the overnight variety. So here he's saying, look, we took control of this company. We're kind of active investors here, and we purchased it about 5 years ago. Is that what you got out of it too?
Yeah, and he didn't do it quickly. He did it slowly, and yeah, it took him a long time to become a control. So he's very patient, very
Yep.
patient.
Yep. Presently, we own 70% of the stock of Dempster, with another 10% held by few associates. So, pretty much owning the entire company. With only 150 or so other stockholders, a market on the stock is virtually non existent, and in any case would have no meaning for a controlling bloc. Our own actions in such a market could drastically affect the quoted price. Okay, so I think it's important to kind of pause here and talk about I guess what he's acknowledging here is that, look, we own majority of this Dempster stock, and anything that we do will move the price of the stock.
And there is no stock to trade. Very thinly traded.
Yeah, yeah. So this is kind of a good place to be for Buffett, then, right?
Well, he doesn't have an exit situation. How is he going to get out of the market?
I mean, if it's stable, then why does he want to get out of the,
Well,
you
my
know?
my thesis was during these times he is trying to do frequent activities. Maybe over a few years. He's not looking to run a business for a long
Mm,
time.
yeah, he
But I
just
may
wants
be
to.
wrong. Looks like this milk manufacturing company.
He's had it for 5 years.
Yeah,
Yeah,
I'm assuming as yeah, it must be part of the partnership
yeah,
because it's a partnership letter.
right. Yeah,
So
yeah,
maybe he's realizing that running businesses is isn't terrible. That you
Yeah.
can just keep a business for a long time.
Yeah.
Because I wonder if he's what is he doing with the money generated by the business? Is he helping the management grow the business itself?
Or
He
is
must be.
he, yeah, or maybe he's using that capital and using it somewhere else, but
Or
maybe
he's
he's,
using the dividends and letting the dividends come to the partnership and investing it.
yeah, yeah. But anyway, so what we know so far is that, he's bought this company 5 years ago. He got on the board 4 years ago. He owns 70% of the stock, and yeah, let's see what else he has to say. So therefore, it's necessary for me to estimate the value at year end of our controlling interest. This is of particular importance since in effect new partners are buying in based upon this price, and old partners are selling a portion of this asset based upon the same price. The estimated value should not be what we hoped it would be worth or what it might be worth to an eager buyer, but what I would estimate our interest would bring if sold under current conditions in a reasonably short period of time. Our efforts will be devoted toward increasing this value, and we feel there are decent prospects of doing this.
Okay. You have any comments there?
So, is he saying, look, we have to disclose this to you guys since we've had this for a long time, and I think it's important that you guys know. But, um, and some people are buying in and some people are selling out. But we hoped that people would buy in, would be eager to buy in, because we feel like this is, you know, pretty good value. Am I understanding that right?
Yeah, I mean, I think he sounds like he's not a seller. So he's
Yeah.
talking about, I think, there's a market for this stock, and there's not a big market, there's no big float, but people are buying and selling, and he's hoping that the stock remains underpriced. He does
Mm-hmm.
not want the price to go to par
Mm-hmm.
because he's saying the estimate value should not be what we hope it would be worth or
Yep.
what it might be worth to an eager buyer.
Yeah.
So, but saying I would estimate our interest would bring if sold under current condition in a reasonably short period of time.
Hmm.
Anyway, he said like I mean, they want to add value. They want to increase the value of this business,
Yeah.
increasing value, and we feel there are decent prospects. So I mean, he's kind of running it like a business then under the partnership.
Yeah. Yeah. So let's see what this company actually does, because I don't think we know it yet. Okay, so Dempster is a manufacturer of farm implements and water systems, with sales in 1961 of about $9 million. Operations have produced only nominal profits in relation to invested capital during recent years. This reflected a poor management situation, along with a fairly tough industry situation. Presently, consolidated net worth or book value is about $4.5 million or $75 per share. Consolidated working capital is about $50 per share. And at year end, we valued our interest at $35 per share. Okay. While I claim no oracular vision, oracular vision. While I claim no oracular vision in a matter such as this, I
Like an
feel.
oracle who can tell the future. Yeah.
Oh, Oracle. But he is the Oracle of Omaha. How do we not know? Okay. So while I claim no oracular vision of matters such as this, I feel this is a fair valuation to both new and old partners. Certainly, if even moderate earning powers can be restored, a higher valuation will be justified. And even if it cannot, Dempster should work out a higher figure. Our controlling interest was acquired at an average price of about $28 and is holding currently, and this holding currently represents 21% of the partnership's net assets based on the $35 value.
What the heck?
Okay, let's talk about this for a little bit. So,
First of all, this is a huge position. This is a huge position for Buffett.
Buffett, yep,
21, I mean, what, 21% of all the money is in
yes,
this stock, and
yes.
they got it at 28. And I'm gonna sad, it's only $35 a share. I thought it'd be like, like 50 or something drastic. When that's
Yeah,
just 50% up. And he's been in for like 4 years, 5 years.
yeah, but what's interesting is that you can clearly see this is undervalued, right? Because he bought it for 28 bucks. He knew that the book value was about 75 bucks and working capital is 50 bucks. So clearly all indications are showing that this stock should grow. Am
Not
I
really. I mean, I think that's a stretch. He's saying actually 35 is a fair value. He's saying $35 is a fair value for sellers and buyers.
Okay, but why this $35 what is that his evaluation on what's fair?
That's based on the profit. I mean, all those working book and the working capital don't necessarily tell you about profits of the business. It's just telling you how much the cash the business needs in its books at a time, and what the real estate is worth.
Hmm.
But based on the profits, he's saying the owner earnings, he's saying it's about $35 per share. You
Hmm.
value our interest.
Okay, and right
That,
now it's $28, right? As of
no,
this.
no, they bought at 28. It is 35. So right now he thinks
Okay.
this is fair. Like instead of selling
Yeah.
because this is a liquid stock, he's saying if we restore the operation, we will have
Mm-hmm.
a higher stock price, and that'll be beneficial for Berkshire partners,
Mm-hmm.
Buffett partners.
Mm-hmm. Okay, interesting. So really here, he's not indicating that he's going to sell or anything, right? He's just saying that it's fair
He's
right now.
actually hinting towards restoring earning power.
Okay.
And he's saying
Okay.
even if we don't uh, boost earning power, he's thinking the share price or Dempster should go up regardless, which it may be because the stock market will continue to go up. I don't understand why he thinks that.
Yeah. Okay. Let's find out a little bit more. Of course, this section of our portfolio is not going to be worth more money merely because General Motors, U.S. Steel, high seller,
Sell higher.
or sell higher. Okay. In in a raging bull market, operations in controlled situations will seem like a very difficult way to make money compared to just buying the general market. However, I'm more conscientious
Conscious.
conscious. However, I'm more conscious of the dangers presented at current market values or current market levels than the opportunities. Okay. Control situations, along with workouts, provide a means of insulating a portion of our portfolio from these dangers. Okay.
Oh, yep.
Well, I kind of don't get how General Motors or U.S. Steel, whatever, if they price this higher, just and then that means that we should be getting more money. I kind of don't understand why those guys came in the game. But from what I understand from this, he's saying that um, this is taking a long time for this thing to appreciate. But that's okay because we have these other two sections which should insulate us from, this waiting period. Is that true?
Well, I think what he's saying is this is a control situation,
Mm-hmm.
right? If he has control, he can make management type decisions or he can guide them. And he thinks the market is overvalued,
Mm-hmm.
right, overall.
Mm-hmm.
And it's very bullish. So in something like this, the obvious thing that most people would want to do is just buy the index.
Mm-hmm.
Because index is going up, it's easy money. Why will you not do this? Like, I
Yep.
mean, you're comparing yourself to the index.
Yep.
And it's going to become harder and harder as the raging bull goes higher and higher.
Mm-hmm.
And what is the bull market? Let's compare with Dow and U.S. Steel and General Motors, and these are big companies that are part of the Dow.
Okay.
Just because those goes up, I mean, he's going to be left behind because he's sitting in a controlled situation of a very illiquid stock,
Right. Okay.
and that stock's not going to change with the market.
Okay.
But because the market is so overvalued, he prefers more certain things than the stock market, and those certain things are special situations where he knows a timetable, he can predict it, and control situation because he's part of the management and he knows what is going on and he can predict that.
Okay. But control situations are, he did admit that they're the longest wait time, right?
Or
For it to get to the price where he thinks it's okay to sell.
not necessarily. He's saying cheaply. He said the opposite. He said if something is cheap for a long time, then it's a higher chance it'll become a control situation because he'll be able to slowly buy a big
Oh, I
position.
see. Okay, okay. Okay, so the point of all this is so that the longer you wait and keep buying more of the stock, the more ownership of the company you'll have, then you'll be able to make it a control situation and then have more
Because he
power
doesn't
that way.
believe in, he doesn't want to
Yeah.
do big buys at the same. He's definitely doing dollar cost averaging,
Interesting. Okay.
and probably because these are liquid stocks, you can't buy a lot.
Yeah.
You have to buy slowly over time
Wait, why? Why can't he just go all
because
in?
there are no sellers. They're very
Oh, I
thinly
see.
traded. Like you
Okay.
need a seller, so you have to buy over a long time.
Interesting. Okay. Um, the question of conservatism. The above description of our various areas of operation may provide some clues as to how conservatively our portfolio is invested. Many people some years back thought that they were behaving in the most conservative manner by purchasing medium or long term municipal or government bonds. This policy has produced substantial market depreciation in many cases, and most certainly has failed to maintain or increase real buying power. Okay, so he's saying, um, how conservative are we being really? And, you know, previously people thought that purchasing these long term bonds um, was the way to go, but it may be the case that you'll lose buying power if you just hold on to these bonds. Yeah.
Yeah, I mean he's saying like we are very conservative. He wants to be conservative, but fears other people thinks being conservative is just buying bonds and not stocks.
Yep. Yep.
And the goal of investing is to increase purchase power. You want to be able to purchase more things tomorrow than you could today.
Yep.
And by investing in bonds, people thought they were being safe and conservative, but they were actually actively losing purchasing power.
Okay. So
So he
is
doesn't
this
invest in
a
bonds.
so is this a lesson that did not invest in bonds while the stocks are going up? Clearly.
It's an investment that bonds should only you'd only invest in bonds if there's a special, really good deal. Most often than not, you should probably buy stocks of good companies, cheap
Okay.
companies. Saying you can increase your yeah. So overall, strongly prefer stocks over bonds.
Yep. Okay. Um, cautious, perhaps overly cautious of inflation. Many people now feel that they're behaving in a conservative manner by buying blue chip securities almost regardless of price to earning ratios, dividend yields, etc. Without the benefit of hindsight, as ill the bond example, I feel this course of action is fraught with danger. There's nothing at all conservative, in my opinion, about speculating as to how high a multiplier a greedy and capricious public will be on earnings. This is incredible. This is speaking to today's. This is he's talking to us in 2021, man. I can't believe it. This is history literally repeating itself. We have got to talk about this. So, cautiously. perhaps overly cautiously, of inflation, which is right now. Many people now feel that they're behaving in a conservative manner by buying blue chip securities almost regardless of the price to earnings ratio, dividend yields, etc. That is totally today, man.
It
Tell
is
me tell me
pretty
this is
spot
not
on.
today. Yeah. Spot on. So people are completely disregarding everything, and then they're just buying like, hey, it's the safe bet. Microsoft will always go up. It's a safe bet. You know what I mean? It's
Yeah,
Amazon will
how
always go
much
up.
is
Yeah.
a stock worth? Don't worry about it. It's a good company.
Yes,
Buy the damn stock.
that
Well,
right.
what about valuation? Oh my God, you're wasting your time. Just buy Bitcoin, okay,
Boomer. Yeah, exactly.
or
Okay.
Tesla.
Yeah, incredible. Okay. Without the benefit, and let's go maybe sentence by sentence because this really does
This is
speaks.
yeah. Go
This is so
slowly.
yeah
This is very
yeah
juicy.
yeah. Without the benefit of hindsight, as ill the Bond example, I feel this course of action is fraught with danger. So he's saying, guys, please, this is dangerous. You guys just buying shit without knowing what's in it, or
And these are people who are trying to be conservative. These are
yeah.
people trying to lower their risk, and they're doing the opposite.
Yes. Okay. There's nothing at all conservative, in my opinion, about speculating as to just how high a multiplier a greedy and capricious public will put on earnings. So
Damn, he just called us greedy.
I know, bro, sell everything, go into something else.
And he called us capricious. What does that mean?
I don't know, but it sounds bad.
Damn.
That's crazy. Any other thoughts on it, or should we continue?
No, it's just amazing how
History
this kind of
repeats
ties
itself.
into the whole like Babri stuff as well. I mean, true risk reduction and being safe is lowering your downside. I mean, if
Yep.
you can't protect your downside, then then it's not a good investment,
Yeah. Yeah. Yeah.
regardless of the company. I mean, there's something to be said about buying incredible business, and it doesn't really matter what you pay for it because it'll continue to do amazing in the
Yep.
future.
Yep.
But you don't know the future, and all these 100 bagger wannabe investors. I mean, yeah, in hindsight, you should have invested, and who cares how much you were paying for it?
Yeah.
Even Google, like 10 years ago,
Mm-hmm.
probably PE of 100 and 200.
Mm-hmm.
You should have just bought the stock. But
Mm-hmm.
there's a reason Buffett did,
Mm-hmm.
because it didn't make sense.
Yep.
And
Yep.
not everything needs to make sense. If you just stick to things that do make sense, you will do just fine.
Yeah. But what's interesting is why did like so if that's the case, where should I be putting my money in if not into these blue chip markets? Is it just
And then
undervalued
valuing
company?
things, doing your own valuations of buying things
Okay.
that are selling for a discount.
Yep. Yep. Makes sense. Okay. Even though it might not look sexy, right? Because think about it. This guy's been at this game for 5 years, on this company, on the board. Really not that hot in terms of investing and in terms of the value of the stock going up. But he's still like, hey guys, I'm not moving. This is
I
undervalued.
mean, overall, also, index is not a terrible place to put your money in. Just because, I mean, I wouldn't pick few blue chip companies, though. I mean, it's a philosophical argument. Are index funds bloated? And I tend to agree they are, because everybody just is dumping money, and we have trillion-dollar companies
Yep.
with multiples of 30.
Yeah.
It's
So
like,
crazy.
how much growth do you
Uh,
expect
oh my
Apple to
god.
do?
It's so insane. Okay. You will not be right simply because a large number of people momentarily agree with you. You will not be right simply because important people agree with you. In many quarters, the simultaneous occurrence of the two above factors is enough to make a course of action meet the test of conservatism. This is so
Wow.
smart. This is so smart. So what he's saying is like, look, you're not going to be right all the time just because a lot of people agree with you for the moment. This reminds me of Tesla. And then the second thing is like, you're not going to be right just because smart people tell you that they agree with you, or important people tell you that they agree with you. You know, this is so come on, why are you guys forgetting about the value of a real company here?
So what is saying that in the last sentence that in many quarters that the and when both these things happen, the sum occurrence of the two above factors is enough to make a course of action meet the test of conservatism. That you will be tested.
Yes.
Like I mean, if it's yeah, I mean, I think social proofs are hard to get rid of. I mean,
Yep. Yep.
even value investments. I mean, it's just like Munger buying Alibaba, and so many people going in after him. It's just it's a
Yeah.
lot of people agree with you, and important people agree with you, and you can
It's scary.
and
Yeah, you're
you think you're
absolutely
being
right.
conservative, but who
Yeah.
knows?
Yeah. Absolutely right. Okay.
That's why you don't outsource your due diligence to other people.
Yeah.
You only buy when it makes sense to you.
Yeah, right. Except in the case of Alibaba, where we double down because of Munger. Okay, let's read on. You will be right over the course of many transactions if your hypotheses are correct, your facts are correct, and your reasoning is correct. True conservatism is only possible through knowledge and reason. Damn.
Beautiful. Beautiful.
I love that. You should print that on a freaking
Dude, this letter is gold. We gotta
yeah,
like,
incredible. It speaks to today, what's going on in today's market, honestly.
yeah,
Okay. I might add that in no way does the fact that our portfolio is not conversational or not
conventional.
conventional prove that we are more conservative or less conservative than standard methods of investing. This can only be determined by examining the methods of examining the results. So look at the hard proof. I feel the most objective tests as to just how conservative our manner of investing is arises through evaluation of performance in down markets. Preferably, these should involve a substantial decline in the Dow. Our performance in the rather mild declines of 1957 and 1960 would confirm my hypothesis that we invest in an extremely conservative manner. I would welcome any partner's partner suggesting objective tests as to conservatism to see how we stack up. We have never suffered a realized loss of more than 0.5 to 1% of total net assets, and our ratio of total dollars of realized gains to total realized loss is something like 100 to 1. Of course, this reflects the fact that, on balance, we've been operating in an up market. However, there have been many opportunities for loss transactions, even in markets such as these. You may have found out about a few of these yourselves. So I think the above facts have some significance.
Okay, summarize.
Okay, so my understanding is that, guys, the stock market's doing awesome. You think that you're going to be doing better if you just put it into these large cap blue chip companies. But I'm telling you guys, the real test comes when there's a down market. How are your stocks doing then? That's the real test of conservatism. That's what I got out of it.
Yeah, I mean, basically, you don't know what's going on till you know the tide has gone, and you
Yep.
see who's swimming naked.
Yep. Yep. You don't know until the shit hits the fan. So what is this? So like I don't understand this the numbers here. So he's saying we're already taking a very conservative approach. The losses are we've never suffered any losses that are less than like 1% of total net asset values. So
Realize losses when he's sold. I mean, whenever he sells something, he usually makes money, and if there's a loss, then it's like
less than a percent or
minus half
1%.
percent
Yep.
or something.
Yep. Okay.
Uh, and of course, I mean, vast majority of time, the stocks he picks, he makes money.
Yep. Yep.
Like 100%, like he doubles his money.
Yeah.
on average, or he yeah, or it's like 1%. I mean, it's ridiculous how much, how like, of each 100 stock he will lose money on one, and the amount of money he'll lose on that one is like 0.5% or 1%.
Yep. That's right. Okay. Okay. Maybe I'll keep going. So the question of size. Aside from the question as to what happens upon my death, with which
He's 30 something. He's already
yeah, they're
thinking.
still talking about death. Come on, man. Everyone's talking about Buffett dying, but yeah, come on. Why is he bringing this up? Let's see. So aside from the question as to what happens upon my death, which with a metaphysical twist is a subject of keen interest to me, I'm probably asked most often, what effect is this rapid growth of partnership funds going to have upon performance? What effect is rapid growth of partnership funds going to have upon performance?
Yeah, like the fact that he's getting more and more money. Like, what is that? Is he gonna slow down? Is his
Okay.
are his numbers gonna suffer?
Okay. Okay. Interesting.
But I like that like, what happens after my death? I'm curious too. What happens when we die?
Larger funds tug in two directions. From the standpoint of passive investments, where we do not attempt by the size of our investment to influence corporate policies, large sums of hurt results. For the mutual funds or trust department investing in securities with very broad markets, the effect of large sums should be to penalize results only very slightly. Buying 10,000 shares of GM is only slightly more costly on the basis of mathematical expectancy by buying 1,000 or 100 shares. Okay. So he's saying, what would happen if I got a lot of money? So there's two things that could happen. The first thing is the the large sums hurts results because you're not able to get as much percentage returns. And is that the first? Is that true? Am I reading that right?
Well, they hurt results because, well, first, you're not able to. Well, let's see. They're saying we're not able to do corporate policy.
Well, he's saying so for mutual funds or trust department investing in securities with very broad markets, the effect of large sums should be to penalize results only very slightly. So he's saying even if I have large amounts of money, it won't change a damn thing. It's going to affect it a little bit.
I think because of mutual funds. Because I mean, if you're in terms of if you're buying 10,000, if you're buying a lot more shares, you will have slightly more transactional costs, is what he's saying, and that means you have slightly higher costs, so you'll have slightly lower returns. That's one point.
Yeah.
But his other point is when you have a large fund that for some reason he's not able to play the control game as much.
Okay. Interesting.
Or I think most of the mutual funds, I think people who grow large, they're doing so many things that they don't have time and energy to maybe do. They want to do more passive things, and they don't necessarily want to take up controlling shares of companies because maybe they're doing too many things. They're too
Okay.
big and they're doing too many things.
Yeah. Can't move as fast. Okay. In some of these securities in which we deal, but not all by any means, buying 10,000 shares is much more difficult than buying 100 and is sometimes impossible. Therefore, for a portion of our portfolio, large sums are definitely disadvantageous. For a large portion of this portfolio, I would say increased sums are only slightly disadvantageous. This category includes most of our workouts and some generals. Okay. Um, okay. So large amounts of money is not um, is is not going to impact workouts in generals. Is that right?
Oh, it will.
Oh,
I
okay, it
think
will. Okay. Why?
no. So sorry. Workouts in general won't be affected much,
Uh huh.
but some of the illiquid companies will be because they can't put that money. They're too big for these little companies where he had been playing. So most of his results have been coming from buying smaller companies or liquid companies, buying shares directly from other shareholders, and doing that. He can't do that anymore because he would need to buy so much more shares, and there's just not enough shares. Nobody's selling them. And even if he did, he would have to do many more deals, like to actually move the needle. He just needs to look at bigger companies,
Yep. Yep. Okay, that
and
makes sense.
he could do the workout deals. But then, even still, if his portfolio is too big, his time would be wasted. Because I think most lucrative workout deals are small deals.
Yeah. Okay. So I would think that if you had more money, because he's talking about what happens if I get larger funds of money, then that would probably mean that it would be easier for the control aspect, because then that would mean you own more of the company and you would have more say.
Yeah, but overall, you just can't. You're moved from the most profits are in the small companies that are
Yep.
thinly traded. And with having a lot more money, he will not be able to play in that arena. He will have to move to more mainstream stocks to show effective returns,
Okay. Yeah.
which will be, difficult. And that's why everybody says if you're new, then you need to look at very small companies. But look, fish where there's plenty of fish and nobody else is fishing.
Yeah. Yeah.
And so I mean, but when you get big, I mean, then you have people looking at right now outside of United States because nothing big in America is cheap,
Yeah.
or,
Yeah.
or
That
most
makes
things
sense.
aren't.
Yep, yep, agreed. So harder to make the needle move. Okay. However, in the case of control situations, increased funds are definitely advantageous. Okay. So a stand-born map cannot be accomplished without the wherewithal. My definite belief is that the opportunities increase in this field as the funds increase. This is due to the sharp fall off in competition as the anti mount pulls the important positive correlation that exists between increased size in the company and the lack of concentrated ownership of that company's stock. Cool, this makes sense because what he's saying here is, hey guys, if we have more money, then guess what? We'll get more control power. Just give me 1 second. So, okay. So getting back to so is that true? So if you have more money, then that means you have more control or the ownership of the larger companies. So this means that you can make more drastic changes in the company, which means you own them more. And so this probably means that you get more concentrated ownership of the company.
I mean that makes logic. So you have more money and you can buy the company because you have
Yeah,
more money.
yeah, yeah. So it makes sense in this situation, but
Yeah,
uh,
but I don't understand what he was saying. I think the control situations maybe are fine where he can make money, but his they're still not gonna move the overall portfolios. Needle is not gonna move, even though he can do the control situations, or maybe he will be able to, and we are understanding it incorrectly. But clearly, he will have more money to take ownership stocks in
yep,
companies he wants to.
yep, that's right. So yeah, it makes sense. I mean, just logically makes sense, right? Because he has more money that he can allocate toward buying more of that company. Yeah. So let's see which is most important: the decreasing prospects of profitability in passive investments or the increasing prospects in control investments. So which is more important? Okay, sorry, I read that wrong. So which is more important: the decreasing prospects of profitability in passive investments or the decreasing prospects in control
Oh,
investments?
that's what he's saying. So he's saying as you have more money, your ability to make money in passive investments where you don't do anything, you just buy and sell, decreases, but you're able to make money and control where you can actually put your money and make things happen, increases.
Interesting. But why would it decrease? The decreasing
Passive.
prospects.
But let's see. I can't. Let's read the rest of the paragraph.
Okay, so I can't give a definite answer to this since, to a great extent, it depends on the type of market in which we're operating. This makes sense. My present opinion is that there is no reason to think that there should not be offsetting factors. If my opinion should change, you will be told. I can say most assuredly that our results in 1960 and 1961 would not have been better if we had been operating with the much smaller sums of 1956 and 1957. Okay, so he's saying regardless of how much money I had, of course, back in 1956 and 1957, I had less money than 1960 and 1961, but our results might have been the same in terms of maybe percentage gains because his mindset has, or his philosophy hasn't changed. I don't know if I'm reading that correctly.
Yeah, yeah. I mean, overall, I think he likes handling more and more money. So as an absolute basis, he can generate more.
Yep. Yep. Okay. So add and a prediction. Regular readers, I may be flattering myself, will feel I have left the tracks when I started talking about predictions. This is one thing from which I have always shined away, and I still do in the normal sense. So he's saying, listen, guys, I'm not going to make no more predictions, or I haven't before either. I am certainly not going to predict what general businesses or the stock market are going to do in the next year or two, since I don't have the faintest idea. That's good that he's, outwardly saying that. I think you can be quite sure that over the next 10 years, there are going to be a few years when the general market is plus 20 or 25%, a few when it's minus on the same order, and a majority when it is in between. I haven't any notion as to the sequence in which these will occur, nor do I think it's of any great importance for the long-term investor. Guys, the stock market is going to go up, down, whatever you want, but I'm telling you, as a long-term investor, just don't care. Just look at the underlying value.
That's right.
Okay, over any long periods of years, I think it likely that the Dow will probably produce something like 5 to 7% per year compounded from a combination of dividends and market value gains. Despite the experience of recent years, anyone expecting stability better than that from the general market probably faces disappointment. Interesting. So he's saying, look, if you just do the Dow, you're going to get 5 to 7%, right? So anyone who's expecting better than that is probably going to be sad because it's not going to happen. Okay. Our job is to pile up early advantages over the performance of the Dow without worrying too much about whether the absolute results in a given year are a plus or a minus. I would consider a year in which we were down 15% and the Dow declined 25% to be much superior to a year where both the partnership and the Dow advanced 20 years. Completely agree. During downward markets, you should be seeing less decline compared to the Dow. I have stressed this point in talking with partners and have watched them nod their head with varying degrees of enthusiasm. It is most important to me that you fully understand my reasoning to this regard and agree with me, not only in your cerebral regions, but also down in the pit of your stomach. You gotta love this guy. Okay. For the reasons outlined in my method of operation, our best years relative to the Dow are likely to be in the declining of stock markets. Therefore, The advantage we seek will probably come in sharply varying amounts. There are both there are bound to be years where we are surpassed by the Dow, but if over a long period we can average 10% points per year better than the Dow, I feel the results have been satisfactory. It's so funny. He's talking about just a few percentages more. He said 7% is what you'd get with the Dow. And if we hit 10%, then you guys should be happy because we beat the Dow. But
No, ten
clearly,
percent's better.
oh,
10% is
10% better.
17.
Okay, so 17%. Okay. So he's still kind of saying, I'm gonna do great compared to the Dow.
Yeah,
So he's pretty
yeah.
confident. Okay, very cool. Anything to add before I continue?
No, I mean he's just kind of reiterating the fact that the goal is to do better than the
Then the
downturn. That's
Dow.
harder than it seems,
Yep.
and that's how you should judge me. And
Yeah.
please don't pull out your money if during the bull run I don't do as well.
Yep, that's right. Okay, so specifically, if the market should be down 35 to 40% in a year, and I feel this has a high probability of occurring 1 year in the next 10, no one knows which one. So we should be down only 15 to 20%. If there's more or less unchanged during the year, we would hope to be up 10 percentage points. If it's up 20% or more, we would struggle to be up as much. The consequence of performance such as this over a period of years would mean that if the Dow produces a 5 to 7% per year overall gain compounded, I would hope our results might be 15 to 17%. So, yeah, just kind of saying the same thing that we just said, right? So specifically, if it's a down market, then we should be absorbing a lot of the blow. So we'll be down as well, but just not as much. And then in the up markets, we should be producing a lot higher. That's what he's
That
saying
is
here.
correct.
Yep. Okay. The above expectations may sound somewhat rash, and there is no question, but they may appear very much so when viewed with the vantage point of 1965 or 1970. It may turn out that I'm completely wrong. However, I feel that the partners are certainly entitled to know what I'm thinking in this regard, even though the nature of the business is such as to introduce a high probability of error in such expectations. In any one year, the variations may be quite substantial. This happened in 1961, but fortunately, the variation was on the pleasant side. They won't all be on the pleasant side. So what he's saying is, look, we outperformed the market here, and it was, and I'm telling you, we shouldn't be expecting this in the future. Is that correct?
Yeah, I mean, yeah, that kind of sums it up.
Yeah. Okay, so let's see. Miscellaneous. We are now installed in an office at 810 Kaywood Plaza with a first-class secretary, Beth Henley. Is she still the secretary? I wonder.
Yeah.
And an associate with considerable experience in my types of securities, Bill Scott. My father is sharing office space with us. He also shares the expenses
All right.
and doing a brokerage business in securities. None of our brokerage is done through him, so we have no vincula coats situation. Not sure what that is. But that's interesting. I didn't even know his dad was alive at this stage. Did you?
Yeah, he hasn't bought Berkshire yet.
Yeah.
That means,
Of course. That's right. He's still alive because he hasn't passed away. That's right. Okay.
but he buys it, I think, next year.
Oh gosh. Oh no, we know what's to come. Okay. But it's cool. It's like a father son, they're hard on this Beth
That's right. This is
family.
like a good, like they're in the same office, they're doing the
Yeah.
same things.
Yeah. Interesting.
Man, he was 30s, in his early 30s when his father passes away.
Oh, that's quite
Oh.
early, huh? Yeah. Okay, interesting. Overall, I expect our overhead, excluding interest or borrowing of Nebraska intangible tax, to run less than 0.5 to 1% of net assets. Okay, so we should get our money's worth for this expenditure, and you are most cordially invited to drop in and see how the money is being spent. Okay, interesting. So overhead is less than 1%, my man, for Berkshire at this moment.
Less than half of a percent.
Yeah, less than half of a percent of net assets. So he doesn't need that much. Okay,
Yeah, he
with
just won office.
with over 90 partners and probably 40 or so securities, you can understand that it's quite a welcome relief for me to shake loose from some of the details. We presently have partners residing in locations from California to Vermont, and net assets at the beginning of 1962 amounted to $7 million, $7.1 million. Susie and I have an interest in the partnership amounting to $1 million, and other relatives of mine have a combined interest of $782,000. The minimum of new partners last year was $25,000, but I'm giving some thought to increase it this year. So remember how before we're like, oh man, only if we had the money we'd do it. It sounds like next year he's gonna be like, guys, the prices are gonna go up. If you want
I'm
to
not
buy
just
in.
making YouTube videos who's like, just so you know, get in here. I'm gonna increase the price pretty soon.
Oh god, that's so
But
great.
it's crazy. I think maybe this is when he had the $1 million mark because he's about 30 and he's a
Yes.
millionaire.
Yeah, that's right. And I mean, you can already see it, right? So CZ and I have an interest in the partnership among
Yeah.
$1 million.
And
Yeah,
they probably have a house on the other side. I mean, they probably bought, but that's like what,
that's right.
$10,000.
Yeah, yeah,
And then they got partners from California to Vermont.
yeah. Interesting. Yeah.
I mean, right? I mean, California. I mean, that's like so. This is not just some obscure dude in
And
Nebraska.
no, he's
People
making
know
his
him.
he's making a name for himself. Yeah.
Nobody in
Interesting.
Seattle or Florida looks like. Huh?
No, no. Yeah, California to Vermont. Interesting.
And he's in 40 stocks.
Yeah.
That's quite a bit.
Yeah. Or so securities. Yeah, that's right. Interesting. Yeah. We don't know
Okay.
which ones, of course, because it's private. So Pete, Marwick, Mitchell, and company did an excellent job of expediting the audit, providing facts, tax figures much earlier than in the past. They assure me this performance can be continued. Let me hear from you regarding the questions that you may have on any aspects of this letter, your audit, status of your partnership interest, etc. That may be puzzling to you. Cordially, Warren E. Buffett. Interesting. Let's look at the appendix really quick. So this is he referenced to it earlier in the letter. So you can see Buffett Associates. Okay. So overall gain. These are just raw numbers. Let's maybe look at this column here. So percentage gain.
So he's comparing himself with other partnerships.
That's right. That's right. So Buffett Fund, Buffett Associates. I don't know what the difference is there.
Oh, these are all the 7 Buffett partnerships.
Oh, I see. You're right. 1, 2, 3, 4, 5, 6, 7. You're right. Okay. So Buffett, this must be family, Buffett Associates. Their percentage gain is about 46. Who are these guys? Glenoff. These guys really got the best gain there. Okay, let's see this one. Partnership started in 1961. Annual investments, Buffett. Overall gains was
Look at how much
35%.
people are putting in, man. $250,000.
Yeah,
When the buy-in's 25,000.
yeah. That's crazy. Buffett Holland, 13%. Analyzed gains. Yeah.
I think that's it.
Yeah, that's right. That concludes this letter.
1961.
Yeah. Interesting. Yeah. Maybe some final thoughts. I'll let you have the final say on this, and then maybe we could conclude.
Yeah, I think the final thoughts. I think I would just say that I think he shared his style more. He talked about broke down the control and the spin-offs and then the generals
Mm-hmm.
and how he expects to do in comparison to the market,
Mm-hmm.
which he always does. But I think he broke it down more, especially because he's growing and he has all these partners joining him, and and he's doing more frequent these letters.
Yeah.
But he's shying away from, like I really want him to discuss
Share the
things
40 stuff.
he's buying and why
Yeah.
he's buying.
Yeah. Yeah.
And I
Yeah.
think he only does that when I think he's closed the position. He doesn't really do it.
Yeah. And he doesn't need to, right? It's a private partnership, so why
He
does
doesn't
he?
need to,
Yeah.
but
Yeah. It would have been nice.
it's being selfish.
Yeah. Yeah. Very interesting. I thought this was fantastic. But yeah, this concludes the 1961 letter when he's 31.
It's kind of like, I mean, it's clearly on downplaying himself. I mean, he doesn't tell us how he continues to do better in the bull market as well, and it's
Yeah.
just annoying.
Yeah. Yeah. But yeah, this has been a good letter. Until next time, see you
Until next time. All right.
in 1962.
962. All right. Bye bye.